Unfortunately, I think America is going to win the currency war, right? Which means Americans are going to lose. It's a race to the bottom. So that's the one war that you don't want to win, because the objective is to kill yourself. But I think we're going to win. But right now, you have a dollar bubble. I mentioned this. You have all these currency speculators that have been fooled by the Fed's monetary magic. They bought into the same head fake that they did in the late 1990s, where they believed the Fed, they had confidence in its monetary policy in the U.S. economy, and so they bid up the dollar. Everybody expects the Fed to be beginning a tightening cycle. They're going to start to shrink their balance sheet. None of this is going to happen. They're getting ready to do QE4. The balance sheet, which is now, $4.5 trillion, is going to explode, ultimately closer to $10 trillion. I think the currency speculators are betting the wrong way. And so when they figure it out, I think the bottom is going to drop out of the dollar. And, we're going to win. I think everybody else is going to surrender in the currency wars and let us win.
Big, bold predictions from Peter, as always. Jeff, I believe you have a question. Go ahead and jump on in there.
Yeah, Peter, thanks for being on. And I know your view of QE4 is finally being illuminated. It's been met with some resistance in the past. But, Peter, I think you're onto something with this QE4. The Fed may have to step in. But what is that exact lever that needs to be pulled? Is it a 5–10% drop in the equity market, or is it more central banks overseas getting in to make the Fed roll out QE4?
Well, part of the goal of QE was to inflate the stock market bubble. Ben Bernanke admitted that himself. And so if the air comes out of that bubble because they threaten to prick it, then yes, they're going to have to do QE4 to blow it back up again. If the Fed were to raise rates, we would be in a bear market in stocks. We'd be in a bear market in real estate. We'd have another financial crisis. Unfortunately, that's what the Fed should do. The Fed should have raised rates a long time ago. They should have pricked this bubble. We need that type of bitter-tasting medicine to actually have a real recovery, instead of the phony recovery we have now that is impoverishing people instead of lifting them out of poverty. But the Fed is going to make the same mistake again. They are not going to allow the free market to fix what they broke. They are going to do QE4. They're going to do QE5. They're going to do QEs indefinitely until a currency crisis ends the party, and then they can't do it anymore. And that crisis is going to come.
Peter, before we get to potentially a QE4 or QE5, I want to kind of button up the segment here, talking about what China's move means for equities. We're sitting at session lows here today. What does it mean today going into the end of the week for equities?
Well, look, I don't think China's move is what's impacting the U.S. stock market. We had been down, 7 days in a row before yesterday. That was the biggest losing streak in 4 years. I think the Fed is threatening to take away the punch bowl, and people actually believe them. I think they're getting ready to spike it again, but I think the markets is going to be under pressure until the Fed cries uncle, until Janet Yellen comes out and acknowledges that the economy is much weaker than they're pretending, and that they're not going to be raising rates, that they're going to be doing more monetary stimulus. That is what the drug addicts on Wall Street want. They want another fix, and I think the pushers at the Fed are going to provide it, unfortunately.